Alright guys, welcome back to this section. If you're just joining us for the first time, it's likely that you have not watched our previous videos, so please kindly go back and watch our previous videos so that you can catch up with what we are doing here. And in this section, in the previous section, we talked about how to calculate the free cash flow. We discussed about what free cash flow is and why it's important to a business. In this section, we're going to be computing our cost of equity. First of all, what we're going to do is to link our loan, our funding part. So we're going to come back to our funding. Say equals to go to your input, equals to go to your input. So you're going to come to your equals to and go to your cash flow statement. You can find that there. You can find your loan there. So what is the loan? So our loan is 80,000. Then our equity is also there on the cash flow statement, which is 120,000. Now equals to, then you sum everything up together. You sum everything up, give it this, right? Now this is your total funding. This is your total funding. You have extra funding of 200,000. We're going to calculate the percentage of the total funding. What is the percentage of the loan on the total funding? So you're now going to say 80,000 divided by 200. What is the percentage of the equity to the total funding? So it's going to be the equity divided by the funding. So you put this one in percentage, sum this up, you put this one in percentage. So you put it in percentage. So we have now gotten our percentage for equity. Now let's now talk about the cost of equity proper before we start the calculation. Cost of equity in simple terms is the return or profit that investors expect when they invest in a company's stock. When a company raises money by selling shares, investors take a risk because stock prices can go up or down. In return, they expect to earn a certain amount of money. So the expected return now is what we call the cost of equity. And what does cost of equity do to a business? Now, a company can raise money through loans or by selling shares. Now, if the cost of equity is higher than the cost of borrowing, the company may prefer loans instead of actually issuing new shares. Right now, another thing the cost of equity does to a business is it is used in the valuation of that business. Now, investors and analysts use cost of equity to calculate company's value and determine if it is good investment. We're going to now see how to define some terms. So under the cost of equity, like we say, the cost of equity in simple terms is a return expected by investors. So before we calculate the cost of equity, if you look at here, these are further research you can do or you should do before you decide on which one to go for or on which rate to use. So these are further research. It is not something we calculate. Now we use economic metrics from the publications on the Federal Gazette or on the stock market. You can get these informations. You can get the free risk-free rate. You can get the equity market, equity or market risk premium and the beta factors. You can do research on that, on the company and on the industry specific that you're modeling for to get these values. So let's format this into a percentage. So this is what we have as a percentage. So let me now explain what risk-free rate is before we can start to calculate that. So we say that the cost of equity helps businesses and investors understand how much return is expected from the company shares. So before we calculate our cost of equity, let's define these terms. Like the risk-free rate is something you can browse. You can just browse the risk-free rate based on the country you're operating in, and all these other things are further research you can be doing as an analyst. So for the purpose of this training, we are using these values. Okay, we're using these values, but let's define the values. Let's define these values. Let's define them first before we can start calculating them. So what is risk-free rate? That's the first question that will come to your mind. Now, risk-free rate is the return you can earn from an investment that has zero risks of losing money. Example, government bond, because they are backed by government and considered very safe to invest in. So why is the risk-free rate important in the valuation of a business? Now, it is used to calculate the investment return. Investors compare the risk-free rate with other investment to decide if taking extra risks is worth it. Why should I invest in this business if I can invest the same amount of money in a risk-free business or in government bond investment that will give that will assure me of my returns and will assure me of my money. Now, another thing we are going to look at, another reason why risk-free rate is important is it affects cost of equity and cost of capital. Another important thing to note about the risk-free rate is that it impacts loan interest. If the risk-free rate goes up, bank and lenders increase interest rate on loans and mortgages, right? So these are things that a business also looks at. So example of risk-free rate investment you can do either in Nigeria or in the US. We have the US 10-year US Treasury bond is often used as the risk-free rate. So the risk-free rate is the foundations of all investment decisions. It helps investors and businesses compare risks and returns, making it a key factors in finance and valuation, right? So the next one we are going to now talk about is now the market risk premium. The market risk premium. Now, the market risk premium or the equity risk premium is still the same thing. That's why I put the slash there. Now, the market risk premium is the extra return investors expect for taking the risk of investing in stocks instead of risk-free rate investment like government bond. That's what we are saying. So the investors will look at all these values. They will not look at the risk-free rate. So what is the extra return? Now, if you look at it here, if you look at the percentage, so you have 4.5 as the risk-free rate, then the higher of that 4.5, which is 3 point something or 2 point something, is what the investor is now looking at. Since stocks are riskier than the government bonds, investors need a higher return to compensate them for that risk. So that is why we have the risk premium. So the risk premium, the market risk premium is now the extra return the investor expects to get at the end of the period. And what this does to investors is that investors compare the potential returns of stocks with the market risk premium to see if the investment is worth the risk. They first of all assess to see if the investment is worth the risk, and also they use it to calculate the cost of equity. A higher market risk premium means investors demand more returns, which can lower the stock price and companies' valuation. So the market risk premium, like I said again, it helps investors understand how much extra return they need to take on stock market risks. It is a key part of investment decisions, stock valuation, and financial analysis, right? So the next one is to look at the beta factor. Now, what is the beta factor? Beta factors measures how risky a stock is compared to the overall stock market. It measures how risky a stock is compared to overall market. We are saying that if a stock has a higher beta of greater than 1, it is more volatile, that it is more riskier than the market. But if a stock has lower beta, that is less than 1, it is less volatile, that is safer than the market. If a stock has a beta of equals to 1, it moves exactly like that of the market. So that is what we are trying to explain, trying to do in the method. So what is the effect of a beta factor in a company investment, right? So the effect is that it measures risks. Beta tells investors how much a company's stock's price might change compared to the market. So beta is a key part of the capital asset pricing model, which helps estimate the return investors expect. Finally, we are going to say that beta factors help investors understand the stock risk level, and decide if they prefer higher risk, higher reward stocks, or stable low risk investment. It is a key tool in finance, especially for valuing companies and managing investment portfolios. So we have to understand it. So all these figures we have gotten online, you can do research based on your country and you get these values. All right. So now it's time for us to calculate our cost of equity. So to calculate our cost of equity, we are going to say equal to our risk-free rates plus open brackets our market risk premium multiplied by our beta factor risk, beta factor rates, right? So multiply by beta factor and you just press enter. You put it in a percentage. Our cost of equity is 4.6. That's our cost of equity. So when we come back in the next section, we're now going to look into the cost of debt. The cost of debt. That's what it costs us to obtain loans